In the previous videos, we talked about the balance sheet, the income statement, and the budget. These are all key financial statements that are going to help you make better decisions in your life. But we don't just do these just for the heck of them. We use these statements to analyze your health by generating a couple of financial ratios. So what we're going to need is to look at your balance sheet and your income statement or your budget to calculate these ratios. We're going to compare these ratios to benchmarks to see if they're good or bad. We're going to track their changes over time. So if we can do this at least once a year to see if a ratio is getting better or getting worse, that's going to help us identify potential problems. And once we identify them, we can correct them. So this video is going to focus on financial ratios that are commonly used in the financial planning industry. These are fairly simple ratios that are straightforward and easy to calculate. We use these to gauge your financial condition. And again, we're going to look at benchmarks. I'm going to tell you what's good and bad, whether higher is better or lower is better. And then if we have a couple of years worth of information, we can look at trends. Are we getting better or are we getting worse with these ratios? The three main ratios we're going to look at in this section are liquidity. We're going to look at how much money you have on hand to meet your emergency needs. We're going to look at your debt repayment ability. And we're going to look at how much you're adding to your savings and investments. So the first ratio, this one is very important. You'll hear this from every financial planner. It's called the month's living expense ratio. This measures your liquidity, which is your ability to put your hands on cash without having to sell important assets. This ratio tells you how many months you can survive, how many months you can pay for out of your emergency savings if you were to lose your steady income. To calculate it, it's very simple. We're going to take your monetary assets from the balance sheet and divide that by your monthly living expenses. This comes from your income statement or your budget. When we're talking about your monthly living expenses, this does not include savings or taxes, but it will include debt payments and your other living needs, such as utilities, food, medicine, transportation, entertainment, and so on. The benchmark for this ratio is 3 to 6 months. We'd like to have enough monetary assets, basically your savings account and checking account, to meet 3 to 6 months worth of living expenses. Somebody that's in a very safe position, they have a steady job, steady income, they don't have a lot of debt, they don't have many dependents. 3 months is probably a pretty good benchmark for them. But someone who has unsteady income, they work in construction, agriculture, or maybe they run their own business, they don't know what their paycheck's going to be from month to month, or people who have lots of dependents or lots of debt, you probably want to see this ratio up closer to 6 months. Some people will actually say closer to 9 months of living expenses. So when we calculate this ratio, higher is safer. Higher is typically better. If it's low, you need to ask yourself, do you have a source of emergency funds, or can you raise money from other sources besides your monetary assets? So let's use the Jethro Gibbs example. To calculate this ratio, we're going to take the monetary assets, which come from the balance sheet, and you can see the total monetary assets for Jethro Gibbs is $10,000. So he has $3,000 in checking, $7,000 in savings, so he can put his hands on $10,000 of cash relatively quickly. To get the monthly expenses, we're going to pull this from the bottom of the income statement or the budget. And if we slide over to Jethro's income statement, remember, we're not going to include income taxes and payroll taxes. We're not going to include savings and investments. We're looking at what your normal expenditures are on a monthly basis. So we have all of our debt payments, utilities, groceries, and so on. In this case, the total monthly expenditures are just over $4,400 per month. So these are the two pieces of information we need to calculate month's living expense ratio. For Jethro, we're going to take the $10,000 of monetary assets, divide it by the $4,400 worth of monthly expenses, and the result comes up 2.3, and the units here are going to be months. This says that if Jethro were to lose his steady income, he has enough cash in his checking and savings accounts to pay for just a little bit over 2 months worth of normal living expenses. So this ratio is below that 3 to 6 month benchmark that we'd like to use. He is single. He typically has a steady income. I'd like to see this number up at least 3 months worth of living expenses. So for this one, if we were to rate Jethro's liquidity, we'll say it is poor. It is not as good as it should be. We would like to see this ratio higher. So how do you improve this ratio? First way I'm going to throw at you is pay yourself first. Remember that principle. As soon as you get your paycheck, move money from your checking account into your savings account or other investments. So in this case, because this ratio is low, we want to improve our savings. So let's take money out of our paycheck as soon as we get that paycheck and move it directly into our savings account. You'll see less money in your checking account, and therefore you'll spend less money, which allows you to save even more. So the first way to improve this one is pay yourself first. Get used to making automatic savings deductions from your checking account. Next way we can improve this ratio is to decrease your expenses. We can go back and look at Jethro's top 5 expenses and see if we can decrease them in some way, shape, or form in order to free up more money that we can put into savings. Also, if it's cheaper to live per month, that means the savings he has will last a little bit longer. So that can help you in 2 different ways. And a final way to improve this ratio is to earn more income. But the big question you have to ask yourself is how? Where's the money going to come from? Do I have time to work more? Can I get a second job? Can I earn overtime? So this one's a little bit harder to do. So with Jethro, his liquidity position is not as strong as we would like to see it. We would like to see this ratio higher. The next ratio looks at debt payment. For this one, we're going to take the total debt payments that you're making and divide it by your gross income. So this is going to include the principal and interest payments you're making on your student loans, your auto loans, your home loans, and any other consumer loans that you might have. The benchmark for this one, the official one, is 38%, but you know what? That's hard to remember, so I just use 40. It's close. We want this ratio to be less than 40%. Think about this. If this ratio is exactly 40%, that says that for every dollar of gross income you're earning, 40 cents is already spoken for your loan payments. So this one, lower is safer. We'd like to see this less than 40%. There are several offshoots of this ratio. This version that I'm showing you is one of the more standard ones you'll see. Please note I do include your homeowner's insurance premiums and your property taxes that you pay on your house as part of your total debt payments. The reason I do this, for a lot of people, these 2 items are already lumped into their loan payment when they make their monthly payment. So for this ratio, we're taking our total debt payments, our total loan payments, which is principal and interest, and we're going to divide that by your gross income. For Jethro, let's look at his income statement to figure out what his total debt payments are. And as we look at his income statement, again, we're not dealing with the top 3 sections, we're dealing with the expenditures. And in this section right here that I'm highlighting, these are his total monthly loan payments. This has the mortgage payment on his house, including the property taxes and the homeowner's insurance. It has his auto loan payment, his personal loan payment, and in this case, just to be conservative, we're going to include this carryover principal on his credit card payments. Again, this is money that he has run up on his credit card and has not paid back over time. You want to be able to pay off your credit cards in full every month. If you do that, do not include your credit card payments in this ratio. So if we total up Jethro's total loan payments, his total debt payments, we'll see that this is going to amount to $1,825. When we look at his gross income, that's going to be up here at the top of his budget. His gross income for the month is just over $6,000. So we need both of these to be on the same basis. So I'm using his debt payments per month and his gross income per month. We'll get the same result if we use his debt payments per year and his annual gross income. But to me, I like doing things on a monthly basis. So Jethro has $1,825 worth of debt payments. He's got a little over $6,000 of gross income per month. When we calculate his debt payment ratio, we're taking the $1,825, we're dividing it by that $6,042 of gross income per month, and this comes up to right around 30%, rounded off. That says for every dollar of gross income that Jethro is paid, 30 cents is going towards debt payments. So how are we going to rate this one? Well, our benchmark on this one, we want to see this less than 40. So Jethro's ratio is less than 40. So we're going to say that his debt payment ratio is good. We would like to see it lower because lower is safer. Lower means less of your gross income is being spent on something out of your control. So how can we improve this ratio if it's not looking too good? Well, we can try and earn more income, but again, how are we going to do this? Can we earn more overtime? Can we work more hours? Can we get a second job? So where are we going to get this income? That one might be a little bit harder to do. The other main thing we can do to improve this ratio is to lower your debt payments. Think about this. What if you use some of the money in your savings account to completely pay off a loan? Once it's paid off, you no longer have to make those payments, so your total debt payments will be lower. So if you have enough savings to pay off a loan, that's a way to improve this ratio. But again, try not to go below 3 months worth of living expenses in your savings accounts. That's for that emergency, for them when bad things happen. We want to be able to have that cash available. Another thing we'll talk about later in the semester is called power payments. And this says that as you pay off one loan, take the money you were paying on that loan and add it to another loan payment. So for example, say you have 2 loans. You have a car payment of $300 a month and a house payment of $1,000 a month. Well, let's pay off that car loan, and then that $300 that we used to make on the car loan, guess what? We're used to not living with that money. So let's apply that to our mortgage, and we'll pay our mortgage down a whole lot faster and save ourselves some interest as well. So we can use some of our savings to pay off these loans. But again, try not to drop below 3 months of living expenses in your savings accounts. Another thing we can do is try and stretch our loans out over a longer time frame. For example, for an auto loan, if you try to get a 3-year loan instead of a 5-year loan, your monthly payment's going to be a lot larger. So if we go with a longer time frame, that will lower the amount of payments you're making, which will improve this ratio. The downside to this is the longer the time frame, the more interest you're going to pay on that loan over its lifetime, but at least it frees up some cash and helps you get through the bad times. We'll talk more about that in the consumer loan section. And the last ratio we'll talk about is your savings ratio. Sometimes it's called the savings and investment ratio. We like to say we use different terms for everything in personal finance. What we're going to do is take the amount that was added to savings investment from the budget and divide that by your gross income. Again, I've said this several times already. I want you to use a personal goal of 10% for your savings goal. So try to save 10% of your gross income. If you can't do that, like I said, 5% or 2% or $5 a week or $10 a month, but work your way up until you get to that 10% level. This ratio, it says usually greater than 10%. It really depends on your stage of life. Right now, you don't have a lot of income as students, so it's really hard to try and save that money. Once you're older and you have a lot less expenses, you have a higher salary, it may be very easy to save and invest more than 10%. So this one, again, varies by the stage of life. As a general rule of thumb, we'd like to see it greater than 10%. For Jethro, we're going to take the amount of savings and investments he added during the month. This is on his income statement, and it's this number right here, the total savings and investments coming out of his budget, so $150, and we're going to divide that by his gross monthly income. Again, we can do this on an annual basis. Just be sure to keep your units consistent. So we have $150 per month divided by a little over $6,000 per month, gives us right around 2.5%. This says that Jethro is saving and investing 2.5% of his gross income, or for every $1 that he has in gross income, he is setting aside 2.5 cents towards his savings and other goals. This is low, especially at Jethro's age. He probably should be up closer to 10%, if not above 10%. So how do we improve this ratio? A, pay yourself first. Set that money aside as soon as you get your paycheck. And again, you'll use your other money more wisely. And the second way is to focus on your expenses and take those needs versus wants into account. The needs are the things we have to have. Housing, food, shelter, energy, and so on. The wants, that's the fun stuff in life. So if you can reduce that unnecessary spending on your wants today, we can save up some money, be in a more solid financial position, and then you can use that money later on in life to really go wild with your wants. So let's look at Jethro's situation from a financial planner's standpoint. We determined that his month's living expense ratio was low. So what we need to do, again, is increase your savings. So how can he increase his checking and savings accounts? Where's that money going to come from? Is it through additional earnings or through cutting down on some of his expenses? Or when we look at his income statement, let's focus on his top 5 expenses. So as we look through here, you can see that his mortgage payment and his auto loan payments are the 2 largest expenses that he has. Maybe he can go talk with the bank to see if he can refinance these, make them a little bit smaller, and that'll free up some money for him every month. Otherwise, as we scroll down here, we can see that home repair is a large number for Jethro. From a financial planner standpoint, I'd be asking, does this mean you're spending $475 on average per month on home repairs, or are you renovating your house and you had some one-time expenses? So we can ask some questions, get deeper in that, and see how he's actually spending that money. Food is usually a big item on your budget, so let's look at his groceries and his food away from home. In this case, he's spending just under $300 a month, which is pretty close to a benchmark I like to use. If you think about $300 a month, that's equivalent to about $10 of food per day. So I think he's in the ballpark there, but he can look at ways of reducing these expenses, such as using coupons, making a grocery list and sticking to it when he goes shopping, eating out less and fixing more of his own meals. So we can look at ways to be a better shopper from the grocery standpoint. People say, let's get rid of some of these smaller amounts. Well, let's focus on the big ones. That's where you're going to have the biggest impact. Satellite TV, internet access, and XM radio. Does he need all of those? Can he do without some? With his phones, he's got a landline and a cell phone. Does he actually need the landline? Can we cut that one out and free up some cash? Propane is probably for his heating, so we can ask, is this an average number? Can we reduce that by being more energy efficient? And as we scroll down, and we can start to ask him questions about how he spends his money to get him thinking about it. Don't question him. Don't tell him he's doing a bad job. Don't tell him or ask him why he's spending so much money in some areas, but ask him to explain. Because when you ask somebody why questions, it puts them on the defensive. So let's look at some of these down here. We've got hobbies, we've got miscellaneous, we've got vices, and we've got recreation. Folks, those add up to over $600 a month. Is there a way to reduce those expenses without significantly hurting his lifestyle, or should he think about making a change in his lifestyle? Another thing we might be able to do is pay off these credit cards, and that'll free up $100 a month for us. Or what if we paid Dad off on his personal loan? That would free up $200 more, and we can use that either to prepay some of our other loans or put that in our savings account, which is going to help improve our month's living expense ratio, our debt payment ratio, and our savings and investment ratio. So these are questions you're going to ask as a financial planner. Where is this money going? How did you get these numbers? But don't force your goals or your values on them. You need to work with their goals so we can help them achieve the lifestyle they want. Here's a little real-world financial planning situation that I ran into. I was working with a very low-income lady, and we sat down and looked at her budget, and she was barely making ends meet. She barely had enough money to meet her expenses. I kept asking her questions. Are there any other expenses that we don't have listed? Is this an average for the year? Does this vary throughout the year? And I kept asking her, is there anything else? She said, well, I don't have cat food or vet bills on here. I said, tell me about your pets. She said, I've got some cats. I love my cats. They're the most dear thing in the world to me. And I said, well, how many cats do you have? And she said, 14. She has 14 cats. That's 12 to 13 more than you normally see, to be honest with you. So me, being a jerk, says, well, ma'am, 14 cats is an awful big expense for you each month when it comes to food and vet care. Can you maybe do without a few of those cats? Can you give some to friends and relatives so you can still go see them? And folks, she started crying. Her eyes teared up, and she said, my cats are the most dear thing in my life. They're the only thing I care about. So that was a situation where I was sort of forcing my values on her. As a financial planner, you need to work with their values and their goals. Remember, you're working to improve your client's life, not to impose your values on them. So once I realized how important her cats were to her, I said, okay, well, there's nothing we can do about this expense. We're going to have to cut something else. And then I asked her, of these 5 expenses that we identified, which ones do you think you can actually cut and not hurt your lifestyle? So there's a little real-world situation. Learn from my stupidity. Don't force your values on other people. So these are just some of the things we can tell as a financial planner when we're looking at somebody's budget and then their balance sheet to try and help them improve their financial condition.